of mine, IAS2. IAS2 is the standard of inventory. What is inventory? So inventory are those assets that are held for sale in the ordinary course of business. So let's use an example of an asset which we call vehicles. So vehicles as an asset, it can be property, plant, and equipment if it is used for administrative purposes, but also it can be used as a rental property. So vehicle can be used as PPE, but for rental purposes, but also vehicles can be used as items held in the ordinary course of business if you are a dealership that deals in selling vehicles. But also inventories are those assets that are used in the process of production for such sale. So a sale, that an asset that is held for sale in the form of material or supplies to be consumed in the production of such sale. Think about an item such as tires. So tires are used in the production of a vehicle. So the focus of our class today is on the measurement of inventory. How do we measure it? And we know that we have to talk about how we measure an item at initial measurement, meaning at the time of acquisition, and how we measure it subsequent to acquisition. So our class is focusing on the measurement at initial measurement. So there's three aspects to the cost, because we initially measure inventory at cost. So what should be in accounting capitalized to the cost of inventory? So we say there's three items. There is the purchase price, purchase costs that have to be capitalized. There are conversion costs that must be capitalized and other costs. So let's start with the purchase cost. So a purchase cost includes purchase price. It also includes taxes such as import duties if you are purchasing these assets from overseas, and all other taxes unless they are claimed back. But it excludes an item of taxation such as value-added tax. It also excludes trade discounts that you've received, bulk purchase discount, cash discounts, and other settlement discounts. You do not include them on the cost that you initially measure inventory with, but you add costs of transportation, because typically when you purchase an item of inventory, you incur these costs that you call transport inwards to bring it to your facility. So those kind of costs are included. Conversion costs. So there are two types of businesses: retail businesses that purchase inventory and sell them, purchasing them as finished goods, selling them as finished goods. But also there's manufacturing business that create this finished goods. So it buys raw material, but it must incur these manufacturing costs to convert it into a finished good. So think about you manufacturing a car. You have to purchase an engine, you have to purchase tires, and then you have to employ people to assemble them to get this car together, but you have to rent space for this car to be in. So some of these costs, we call them variable costs, and some we call them fixed costs. Examples of variable costs are direct material and direct labor. But what is a variable cost? So we say a variable costs are those costs that vary directly or nearly directly with the volume of production. So when you're manufacturing a car, you have to purchase 5 tires every single time, a spare tire and 4 tires. You have to have an engine. So an engine varies with the volume if you're increasing the units that you produce on a car. engines vary with that, and also direct laborers, people that are directly involved in assembling cars. The more the capacity of the units that you produce increase, the more laborers that you have to employ. Also, the material costs vary as well. But what are fixed costs? So fixed costs are those costs that remain relatively constant within a relevant range, regardless of the volume of production. So what are those costs that remain relatively constant regardless of the volume of production? An example is renting space of production from an industrial development zone to produce that car. You can produce 50, the rent is the same, 70, the rent is the same. But now if you want to produce 1,000, you start needing more space. So hence we use relatively constant, because the more production you would be forced to have additional space. And then other costs. What constitute other costs? Other costs are costs such as those costs that are needed to bring the items of inventory to their present location and condition. Costs such as storage costs directly related to production. Costs that are non-production costs such as design engineering costs. To design that car, it has to be allocated to the cost of inventory, right? But they are not directly related to production overheads. But what are the costs that must be excluded? So costs that must be excluded are costs such as abnormal waste, are costs such as storage costs not directly related to production, a general administrative overheads like the secretary that is not the secretary of the plant, for instance, are costs such as the selling costs, marketing costs, and general administrative costs. Those are not included in the cost of inventory. And then how is inventory subsequently measured, which we'll deal with on our next section? It is measured at the law of cost